I guess the one anomaly at your end of the market, Troy, is the payout of dividends from the miners that have not traditionally been income style stocks, and there's been some big dividends come through. Do you feel, we talked again last time, we talked about them changing their spots and capital discipline.
Yep.
Do you see that trend continuing in these companies?
Yeah, it's likely to persist, definitely. Pretty much across all the major miners that we look at, so the likes of BHP, Rio Tinto, Fortescue, even the smaller guys, you know, South32, Iluka, etc. They've all embraced capital discipline and the need for good cash flow returns to investors, and equally, more appropriately, not to invest capital at sub cost of capital rates of returns. And they've been, all of them collectively have been actually very disciplined to date. But you know, cycles, they start like this and they're like this through the middle, and they end when that discipline goes out the window. So we're not there yet, but it's something that clearly we're watching.
I think I saw a statistic that it may have been in large caps that in 2018 it was the first time that more capital was returned to shareholders than was actually invested into new business development.
Yeah.
Is that just a sign of, you know, what Matt described with Australia as just a lack of opportunities, or slightly benign opportunities domestically?
Well, I think as it relates to the miners, it's perhaps the capital discipline we've spoken about, as opposed to a lack of investment opportunities necessarily. Because, you know, as a miner, growing volumes does not always equate to growing value. And these guys have now recognised that. And the fact that, you know, for example, the miners have distributed more cash than they spend is probably more a reflection on the fact that commodity prices have been at elevated levels and managed to stay there. So they're sharing those windfall gains with investors, which is great news.